Hello and welcome to another episode of the Engineering Influence podcast. My name is Diana O Lare and I am the Director of Market Intelligence for the American Council of Engineering Companies here in Washington, D.C. If you're viewing us on YouTube, don't forget to like or subscribe and follow ACEC for more recordings. Now, today's podcast comes to you from The Market Edge, a new podcast series driven by the Market Intelligence Committee here at ACEC. On The Market Edge, we will feature industry experts that address member-specific questions with a focus on market trends and economic insights aimed to empower engineering firms to drive growth, adapt to change, and maintain their competitiveness. Today, we will be joined by Senior Economist and Strategist of Morgan Stanley Wealth Management, Sarah Wolfe, where we will cover everything from tariffs to inflation, immigration, the overall economy, and if there might be any bright spots or opportunities in all the volatility we are seeing today. Sarah, thank you so much for joining the podcast today.
Thank you for having me, Diana.
Absolutely. A little bit more about Sarah before we dive in. She's a senior economist and strategist at Morgan Stanley Wealth Management, covering macro and thematic investing. Prior to this role, she was on the U.S. economics research team for 5 years. She received her BA in International Studies and Economics from Johns Hopkins University and MA in International Economics from the Johns Hopkins School of Advanced International Studies. She's also worked at the World Bank in Washington, D.C. while completing her master's, and she also mentors and teaches economics and financial literacy to high school students in the Morgan Stanley Jumpstart Finance Program and is a visiting lecturer at Johns Hopkins University and chairs the Policy Survey Committee for the National Association for Business Economics and Programming Committee for the New York NABE chapter. I first heard Sarah speak on a panel at an event for the National Retail Federation, and I thought engineering firms would be very interested in what she had to say. So let's jump right into some questions. So my first one I have for you, Sarah, is there's a lot going on right now. And one of the top mind topics is tariffs. So can you tell us what sectors have the most exposure due to tariffs? Our members will be interested in construction materials, the manufacturing market, and auto sales.
Yeah, definitely. And unfortunately, the sectors that you just covered are probably the most impacted by tariffs. If we look at which industries have the most exposure to tariffs by their input costs, the ones that come up as the highest are computer and electronic products. Then you have electrical equipment and appliances, machinery. You also have furniture, plastics and rubber, apparel. So it really is broad across both the industrial sector and the consumer sector. And what we're seeing already in some of the business surveys and consumer surveys is that there's already a lot of concern across both parts of the economy because it's going to raise input prices for companies and consumer prices at the end. And even beyond just more of the industrial sector, construction. So if we think about home building, lumber prices are going to be impacted. We've already heard that home builders are trying to source lumber from the U.S. instead of Canada to reduce costs. And even beyond that, if we think about input costs that are going to impact the manufacturing and construction sector, labor is a really big thing to consider as well, in addition to tariffs. And we could talk a little bit more about that later on what's happening with immigration policy and what that's going to mean for businesses' bottom line.
Now, when you and I talked before this call, you mentioned how the soft data wasn't lining up with the hard data, at least not yet. It kind of reminds me of the longest awaited recession that we all feared for the last 4 years that never came. And we're seeing from our members that industry sentiment is starting to come in and is trending down again. But will a recession, do you think, follow this time? Will there be a cliff coming in this hard data that seems to be showing that everything's okay right now?
Yeah, so maybe I'll take that in two parts. The first is how are tariffs impacting the sentiment data, what that means for the economy, and then what are some of the sources of a recession. So if we look first at the second part, there's a lot of sources of a recession right now. If we compare today to 6 months ago, recession probability 6 months ago were probably somewhere around 10 to 15% in the next 12 months. Today, you have estimates all the way from 40% to 80%. So people think that there's a fairly significant chance that we could enter a recession. And if you just look at the median forecast for U.S. GDP growth this year, it's hanging around 1% relative to 3% last year. That's not negative, so that's not a recession, but that significant slowdown from 3% is going to feel recessionary for a lot of sectors. And there may be certain sectors within that can track while others perform relatively better. For example, the services sector is going to be more insulated from tariffs than the goods side of the economy. So there's definitely a lot of channels for a recession, whether it's financial market volatility, the wealth effect, trade policy uncertainty, a slowdown in immigration, but that doesn't necessarily mean we're going to enter a recession. If we think about the fundamentals of the U.S. economy, we're still in good shape. We're entering all of this turmoil on very healthy standing. Household balance sheets are still in a good place. Corporate balance sheet and leverage is still fairly low. So there's a little bit of room to weather the storm. And of course, if we do see a type of slowdown, the Federal Reserve will be likely to lower interest rates, and that'll alleviate some pressure. So now quickly turning to the first part of your question, how are tariffs actually filtering through the economy? And it's really a four-step process. The first, which we saw immediately, was through financial markets, right? We saw a pretty sharp decline in equity markets. We saw interest rates, expectations fall quite a bit off of elevated recession risk, but then they kind of bounce back up because now investors are also expecting higher inflation. So it's a little bit of a tricky situation. And then we saw also the US dollar has weakened about 10% this year as well off of some of the trade news. The second channel that we've seen in order is through sentiment. And this is from consumers and businesses. So consumer sentiment now is looking a lot more pessimistic for the economic outlook and for their financial outlook, a little bit more pessimistic about labor prospects, the ability to find a job, but also I would say most significantly about inflation expectations. Consumers are very worried that we're going to see a reacceleration in prices after we've seen extreme inflation now for about 5 years. So consumers are very price sensitive. The second place we've seen it is in the business surveys. And this really gets to the industry that matters the most for all of you. When we look at the ISM surveys that come from the manufacturing sector, that's really where the sentiment has declined the most. I mean, you could look at it on a regional basis and on a national basis. And what it showed is that new order expectations for manufacturers have plummeted. So people are not placing new orders because of all this uncertainty around tariffs, and prices paid expectations have skyrocketed. So that it kind of looks like what we would call in the economics world a stagflationary-like environment where growth is slowing, but prices are rising, which creates a very difficult situation for the U.S. economy and for policymakers.
So a little bit more on inflation and interest rates and what those impacts might be. Some of our members have talked about developers stockpiling materials like steel and lumber in advance of these tariffs, anticipating the increase of price. Do you think that this will be similar to COVID times where we saw a spike in construction material pricing? Is that what we're going to see, do you think?
Yeah, so we're hearing about this across the business sector and the consumer retail sector where there's been a pull forward of demand. And so what's actually happening in the economic data is that things are accelerating, things are looking better because businesses and companies are buying more right now. So if you look at consumer spending on autos, back in March, it was up 5% month over month, huge month over month increase in auto sales because of that concern around tariffs and what it's going to mean for car prices. And so you're seeing this pull forward of demand and you're seeing a pull forward of inventory stockpiling. And I was recently talking to a leading data provider for the retail sector, and they said they're hearing from their companies that they're pulling forward about 4 to 12 weeks of inventory. And so we have about 2 to 3 more months, right, of inventory that's going to be priced at roughly pre-tariff prices. And we're not seeing that businesses are trying to raise prices ahead of tariffs. They're not trying to get ahead of it. I think there's also a little bit of a customer satisfaction. Nobody wants to be the first business to take advantage of tariffs and raise prices. It doesn't look great. But what's going to happen on a rolling basis in 4 to 12 weeks from now, we're going to start to see empty shelves. And one of the things that we've heard is that businesses that import more than 50% of their goods from China are not only telling their Chinese manufacturers to stop shipments, but also to stop production. So that has pretty significant implications for what's going to happen in a few months from now when inventory starts to deplete. The economic data is going to start to turn and prices are going to start to accelerate because not only are you getting the tariff pass through, but businesses are intentionally not ordering more supply because they don't know how much price they can pass through to consumers. So you're almost getting this double whammy that's going to cause this reacceleration in prices.
That's very scary stuff there. Let's pivot over to policy on immigration and its impact on the overall labor supply. Is there a long game there with implementing tariffs? Will the tariffs give the intended desired result and bring more jobs back to the U.S.? How is that playing out?
Yeah, so I would look at these agendas as separate policy agendas, immigration and trade. I think for trade, there's three possible long-term outcomes of what the administration is trying to do. And I think what's very difficult for business owners and for market participants is to figure out which is the end goal and to prepare for that. So on one hand, Trump could be pushing for free global trade and strong-arming our trading partners to remove their trade barriers, and the U.S. will remove ours as well. And that would be a really positive outcome for global trade. On the other hand, we could be using tariffs as a negotiating tactic to increase business investment in the U.S. That seems to be a little bit more where we're in the camp, right? Because we put tariffs on, but we've taken them off once countries and businesses have agreed to favorable terms to the U.S. and have agreed to increase investment in the U.S. So that means that tariffs maybe won't be here to stay, and they're just going to be for a few months or a year. And then the third outcome is that we need tariffs because we need revenues to offset tax cuts for the U.S. deficit. And what that means is that tariffs are here to stay. We need these consistent revenues coming into the U.S. to help offset the decline in tax revenues. And so that's probably the worst case scenario for global trade and for businesses. And what's really tricky is understanding which is going to be the outcome and what is the angle, because they're all very different. And in my opinion, I do think that we're somewhere in that middle range where tariffs are being used as a negotiating tool. We've seen that increasingly in the last couple of weeks with the 90-day pause on reciprocal tariffs, with recent headlines that the U.S. is working on trade agreements with India and Japan and even with China as well. So, of course, in that scenario, increasing business investment in the U.S. should help increase jobs in the U.S. as well. But it's also not so clear cut because you do get job loss from less imports coming to the U.S. You have a lot of people that work at the ports, right? They're going to be negatively impacted by less trade coming to the U.S. And so it's really hard to figure out if in the end this will benefit the U.S. labor market, because what we've seen over the last couple of decades is even though our manufacturing sector has declined and we've lost almost 5 million jobs in the manufacturing sector in the last 20 years, we've gained 5x in the broader economy, right? Our economy has still grown and benefited. And then just quickly on the second point that you asked about immigration, if we think about what happened during the Biden administration, we saw a massive surge in net immigration into the U.S. We typically have about 800,000 to 1 million people come into the country in a given year through various measures, legal immigration like green cards and H-1B visas, through asylum programs, and undocumented through the southern border. So there's a lot of different channels that immigrants come into the U.S. That more than tripled over the last 3 years. So net 3 million for 3 consecutive years. So we had almost 6 to 7 million more immigrants come into the country. And that really helped resupply labor post-COVID in the U.S. And it was huge for the construction sector, for agriculture, for retail, that really lost a lot of workers during the pandemic. To put some interesting numbers around that, if you look at the Customs Border and Protection Agency, they report flows across the southern border on a daily basis. And at the peak, we had 250 to 350,000 people coming through the southern border in a given month. Tremendous amount of people. Under the Trump administration, just in his first few months, that has fallen to zero through the rhetoric, through increased resources at the southern border. And so this is really a negative labor supply shock to the U.S. And it's going to slowly impact these sectors that rely very heavily on low skill, undocumented workers. And it's going to increasingly impact our labor market over the next 6 to 12 months, because there's a bit of a lag between when an immigrant comes across the border and when they are able to enter the workforce and become employed.
Lots of ripple effects there that not everyone, I think, considers. I wanted to maybe look at maybe where the bright side might be. So what about any potential positive catalysts? For example, in particular, we know the 2017 Tax Cuts and Jobs Act is set to expire next year. What could come of this renegotiation? Any bright spots or any other positives outside of that?
Yeah, I think that the next big catalyst that we're going to be looking at is positive negotiations on trade. I think that there's room for downside surprise and there's room for upside surprise. So hopefully we get the latter, we get that upside surprise. But the other thing is going to be deregulation and taxes, which I think are the more pro-growth pillars of Trump's policies. So deregulation would benefit the energy sector, would benefit the auto industry, would benefit the financial services. Biden spent almost $2 trillion on regulation over the course of his administration. Trump spent barely any money in his first presidential term, so he's made it very clear that he's pro-deregulation. That really benefits small, medium-sized businesses. The other big one is tax cuts. So we've had the Tax Cut and Jobs Act that was rolled out in 2016 as a new policy. It was a 10-year tax cut program, benefited businesses and upper income consumers. That's set to expire in 2026. So we're currently in the process of renegotiating the tax bill. And you're seeing that the House and Senate are both putting forward new bills on how to see the extension of the Tax Cut and Jobs Act. And the fact that we have a Republican majority in the House, in the Senate, and in the executive branch looks pretty good for a full extension of the Tax Cut and Jobs Act, and even possibly further tax cuts beyond what we already have. So maybe increased business deductions, possibly a lower corporate tax rate, no taxes on bonuses or overtime or Social Security payments. I mean, we've heard all these different ideas thrown out. I think in reality, it might be a little bit harder to implement additional tax cuts because everything has to get paid for somehow. So this is going to add to the U.S. debt. But I do think that that's going to be a positive catalyst that comes this summer.
You mentioned deregulation. I know our members here are very interested in that, especially when it comes to permitting reform. Members here are looking for the successful acceleration in the permitting process and expediting and reducing delays and improving the predictability of project timelines. So that's definitely a bright spot that they're looking for. Just a couple more questions here and then we'll wrap up. So on to tech. So what are you seeing and hearing about CapEx and the technology and the data center market? Some members have cited that projects are being significantly postponed or canceled altogether. Do you think this is a tariff-related effect or market uncertainty or a new trend potentially?
Yeah, I think there's some near-term headwinds, but this is still a very powerful and positive catalyst for U.S. growth and productivity. As you mentioned, some of the near-term headwinds are financial market volatility, tariff uncertainty. There's a lot of resources that go into building these data centers. And then also interest rate uncertainty. Is the Fed going to cut interest rates and lower borrowing costs, which would support some of the financing needed for these projects? The other one, which I think matters to a lesser extent, though, is DeepSeek in China, which basically showed that you need less energy to produce similar results on AI. And I think that disrupted the market a little bit, but more broadly, if we look at what some of these big AI companies are saying, there's still a very significant amount of demand and almost an unlimited amount of demand that they need for power. So there's going to be a need for these projects. And even if there's headwinds that delay the start of these projects over the coming year, we're still going to see that this type of, to the tune of hundreds of billions of dollars of capital invested in CapEx technology and the data centers that support them.
All right, one more question. I'm going to talk about another market here. So U.S. airlines reported a recent dip in demand for 2025. Conversely, cruise lines are reporting strong revenues expected in 2025. Do you foresee any tariff travel where Americans would go to Canada, Mexico, or Europe to buy a car, computer, cell phone, mixed vacation to avoid tariffs? Also talk about the potential of countries boycotting U.S. products in return and their impact.
Yeah, so I think what we're seeing, the divergence between the airlines and the cruises is sentiment versus the actual health of the consumer. So I think the airlines are getting hit a bit by this boycott U.S. mentality. International travel to the U.S. is down 15% year over year. We've seen the sharpest decline, right, from our Canadian partners traveling to the US. And so it's less about the health of the consumer and the ability to travel and more about not wanting to come to the US. And that could also impact some of the travel that we get from Europe as well as some of these relations deteriorate. On the other side, the health of the consumer is still intact. We still have a solid labor market. Wealth has been volatile, but there's still a pretty powerful wealth effect from the last few years. And so consumers are still spending on discretionary services, in particular in the US, and that's going to benefit things like the cruises. In terms of US residents traveling overseas to purchase cheaper goods, I think a lot of it is going to depend on how everything shakes out. I do think that, especially with Canada, we will likely see a rollback in these tariffs as the USMCA gets renegotiated over the course of this year, and the same with Mexico as well.
All right. Thank you, Sarah. So that is probably all the time that we're going to have for today. Please join us in person for our next Market Intelligence Committee meeting on May 20th in Washington, D.C. during ACEC's annual convention and legislative summit. Also, registration for our next market briefing will open soon. This will be hosted on June 3rd online with speakers from the National Association of Home Builders who will provide an update on the specific housing market. Lastly, a special thank you to Sarah Wolfe of Morgan Stanley for your economic commentary today. Thank you, Sarah.
Thank you, Diana. Thanks for having me.
And thank you to everyone for tuning in for the latest intelligence on the market edge. This has been another episode from the Engineering Influence podcast. My name is Diana O Lare. See you next time.